Hey Bowtie Nation, Joseph Hogue here with a new look at dividend growth stocks, something you don't see in videos here on YouTube much, but a change I've been making lately. Instead of focusing on that past dividend growth, I found 5 dividend stocks that could lead the market for increasing their dividends over the next 3 years. It's all part of our Perfect Dividend Portfolio series, highlighting the best dividend stocks for your money. I'm covering every dividend type and strategy here, from high yield to dividend growth, monthly dividends, and ETFs. In each video, I'll reveal the best dividend stocks for your portfolio, stocks that are going to put cash in your pocket, including the ones in my portfolio. I'll leave a link to the rest of the videos in the series in the description below, so make sure you check that out. I'll be ranking these dividend stocks from lowest to highest expected dividend growth, including one that has increased its payout for 15 consecutive years and could boost those dividends by 28% a year over the next 3. And it's not even the fastest growth in our 5 stocks. I want to get started though with Eastman Chemical, ticker EMN, but stick around because I'm going to show you how I found these next. Now, Eastman also made our list of safest dividend stocks for its low payout ratio and strong cash flow. You can see here in the statement of cash flows, the company's cash flow has been so strong lately, it's been able to pay down almost $1 billion in debt and repurchase $2.4 billion of its own stock over the last 4 years. That is a sign of dividend safety because if cash flow were to fall, the company could easily pull back on that share repurchases or the debt payoff to maintain that dividend. Eastman has sold off its non-core segments over the last few years and is now focused on those specialty chemicals to diverse end markets. The company's Tennessee facility is set to start generating revenue this year, so we've got top-line growth, and $200 million in cost reduction plan could help drive that profitability and earnings. The company's payout ratio is less than most of its peers, with 36% of its earnings going to pay the dividend, while competitors like PPG Industries has 55% of its earnings committed to that payout, and it's as high as 64% for air products and chemicals. Now, Eastman has grown the dividend by 7% annually over the last 5 years, and that lower payout ratio is going to be a factor in more increases. In fact, Eastman has increased its dividend for 14 consecutive years, and while it might not offer a huge yield at 3.8%, I'm forecasting up to 13.6% dividend growth annually over the next 3 years. Now that's from 8% expected growth in earnings per share, from $7.83 last year to $9.86 a share by 2025, and then catch up to that payout ratio from the current 36% to the sector average of 42%, for another 5.6% potential increase per year. And we're just getting started, and stick around because that last stock in our list could increase its payout by 29% annually over the next 3, but all you out there in the nation know I can't just drop a list of stocks in your lap. I want you to understand how I found these dividend growth names. Look folks, let's be honest here. I know it's easier to get a list of stock picks, but do you really always want to be dependent on some yahoo on YouTube to feed you investment ideas? I mean, when the most popular investing videos look like this, don't you think you should learn how to be a better investor yourself and question the advice you're getting? So please, just bear with me here for just 2 minutes to understand how I found these stocks, the analysis behind these dividend growth themes, and I promise I will make you a better investor. Now, for an initial filter here, I looked for stocks with a dividend yield above 3%. Anything less than that, it's not much of a dividend stock in my book. I also filtered for stocks with at least 5 consecutive years of increasing their payout and at least 5% a year. And this shows us those companies that have committed to increasing shareholder cash return. For this, I used the stock screener on Seeking Alpha. It's an easy screener for any type of strategy, from dividends to growth to value stocks. You just choose the filters you want. Here I'll select from the dividend list, then set the criteria, and the screener is going to update automatically with each new filter. To check that out, click on the link in the description below for an exclusive deal for Seeking Alpha Premium. Save over $140 on the premium features I use to look for stock ideas. This is the lowest price you'll find online. In fact, it's lower than the price I paid when I signed up, so check that out. Now, just that initial screen alone narrowed our list from 1,500 dividend-paying stocks to just 141 companies. Then I compared the payout ratio for each stock against the average for its sector. Now remember, the payout ratio is just the percentage of profits of the company paid out as the dividend. It's usually used as a measure for dividend safety because those stocks with those lower payout ratios, those with the more earnings left after paying the dividend, they're going to be in less danger of a cut, but I'm going to also use it as a measure for dividend growth. For example, the sector average dividend payout ratio for materials companies is 42%, but Eastman Chemical is only paying out 36% of its profits. If Eastman were to boost its payout to that sector average, starting paying out 42% of its earnings, that would mean a 17% increase in the dividend payment, and that's before accounting for earnings growth as well. Now add up that expected annual growth in its profits with the payout ratio growth, and I assumed it would take about 3 years for the company to increase its payout to that sector average. And that's going to give us our potential annual dividend growth rate of 13.6% a year. And you can find the company's payout ratio and the sector average on Seeking Alpha under the Dividends tab for each stock. It's a great strategy for finding those dividend stocks that are going to grow your cash flow. Next is possibly my favorite utility stock, though I want to strangle whoever thought up with the name and the ticker symbol. NRG Energy, ticker NRG. The company is one of the largest energy producers in the United States with over 6 million residential customers and 14 gigawatts of generation across electricity and natural gas. Even though it's an independent provider, it still operates in that protected, regulated market of electric and natural gas, so cash flows are extremely consistent. That's helped management commit to constant dividend growth while still being able to grow the company and the share price as well. And the recent acquisition of Direct Energy is expected to produce over $300 million in savings and drive part of that strategic growth initiative, growing the dual fuel business and streamlining production. And that should result in even stronger cash flow and higher dividends. Shares of Energy were paying a dividend of just 3 cents a share in 2017, but have increased that amount by more than 12 times to 38 cents a share over the last 5 years. That's an annualized 66% increase. Now, I doubt that it keeps up that pace, but I'm forecasting at least a 17% annual growth over the next 3 years. That's because the company pays out just 29% of its earnings as a dividend, well under the 41% average payout ratio for utilities companies. Now, just playing catch up to that ratio over the next 3 years adds 12% dividend growth on top of the 4.9% expected growth in earnings. And I think even that earnings forecast could be too conservative given the Direct Energy acquisition, and Energy could end up pushing the dividend even further. But even if it doesn't, though, you're still set for a solid cash return. Folks, think about it this way, and you begin to see that power of dividend growth stocks. If you were to buy shares of NRG now at $34 each, you're getting a 4.3% yield, which is nearly 3 times the market average yield, but not the kind of prize you take home to meet your parents. But here, if we see that 17% annualized dividend growth, that payout jumps from $1.51 a year per share to $2.52 a share. That is a 7% yield on your original investment. And I'm expecting even stronger dividend growth here from Trinity Industries, ticker TRN, with its 4.3% current yield. I recently highlighted Trinity as my favorite dividend stock in the industrial sector. The company operates in 2 segments here, railcar manufacturing and leasing, with maintenance and services as an add-on providing recurring revenue. Now, earnings have dropped over the last year on an increase in costs, so that payout ratio of 56% is right around the sector average. It won't get much of a dividend boost from raising that payout percentage, but earnings are expected to double this year. In fact, management increased the dividend in January, a strong show of confidence for that cash payout. Earnings are expected to grow at a 20% annualized pace over the next 3 years as well, which takes that $1.04 current dividend to $1.80 per share if the company keeps that same payout ratio. And that puts that cash return at 7.5% on the current price of the shares. 2 more dividend stocks to highlight, but I want to get your input on this as well. Does dividend growth really matter to you as much as yield? And what I mean is, while the average dividend on these stocks is still more than 2 times the market average, it's not as high as some of those high-yield stocks that we've covered. Now, I think the dividend growth on these is going to surprise over the next few years, taking that stock price and the cash payment higher, but which would you rather have, a higher current yield right now or the potential for stronger dividend growth? Let me know in the comments what you want to see in future videos. A rebound in car sales could help Magna International, ticker MGA, grow its 3.5% dividend over the next few years. Magna is one of the most comprehensive component manufacturers for the automotive industry, designing and producing everything from powertrain systems to mirrors and seating. Auto sales plunged last year after that stimulus check-fueled rebound from the pandemic and are still down more than 2 million annual sales from pre-pandemic. Despite that, the company was still able to produce $400 million in free cash flow last year and increase its dividend. In fact, Magna has increased its dividend for 15 consecutive years. Now, car prices are starting to come down, and a drop in interest rates next year could spur a recovery in car buying. And that could help drive earnings growth of 26% a year over the next 3 years, according to analyst estimates. The company's payout ratio of 30% is just under the 30% average for stocks in that sector, adding another few percent to that potential dividend growth, a 28% increase in the payout. Now that takes the current dividend from $1.84 up to $3.85 a share, or a 7.4% yield on the current stock price. We've still got that last dividend stock to highlight, one that could increase its cash payment by 29% a year, but with the market shaky at best, every investor needs some dividend safety stocks. Check out the video here for the 5 dividend stocks with the safest payments, stocks that will never let you down. American Tower, ticker AMT, has the lowest dividend yield of the group at just 3.1%, but the highest potential upside to dividend growth, as high as 29% a year. The company is the largest global owner of communications real estate, owning the land and the cell tower structure. AMT has more than 225,000 sites across the globe, with a strong focus in emerging markets where that cell penetration is still growing. And the company's recent acquisition of CoreSite puts it in another high-demand property type, with 25 data centers across the U.S. Revenue has grown at an annualized 14% pace over the last decade, allowing the company to double the dividend over the last 5 years. That expansion into the data center growth market should even add fuel to that fire and grow over the next few years. Now, for real estate investment trusts, you want to look here at the funds from operations, or FFO, instead of those earnings. FFO is just a purer measure of cash generation and determines how much the company can pay out as its dividend. We can see here with the NAREIT data, AMT is expected to grow its funds from operations by 10% this year and 11% next, though I think they can beat that with the CoreSite acquisition. We also see in the last column here that the company is only paying out 48% of its FFO for that dividend, well under those other infrastructure REITs like Crown Castle with its 82% FFO payout ratio. So on that 11% annualized FFO growth, we can add another 18% potential dividend growth if the company were just to increase its payout ratio to the sector average. And that could mean an upside of 29% annual growth on that dividend, turning that current $6.24 payout into $13 a share in the next few years. Get that exclusive deal for Seeking Alpha Premium with the link below, or click on the video to the right for the 5 safest dividend stocks in the market, stocks that will never let you down. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.